charts. Let's reference this. This is the S&P 500. Now I'm going to talk about the S&P because it is 500 of the biggest companies rolled into one index. When I talk about the NASDAQ or the Dow, or you hear about that, the Dow is 30 of the biggest, and the NASDAQ is tech-weighted heavy. The small cap index we're not going to talk about, even though that is the weakest. So that should be very telling, by the way. So the S&P is the most liquid. In fact, the volatility index that you hear about is comprised of the prices of put options for the S&P 500. And it is often gauged as the fear index. So that's the price that people want to pay for protection to the downside. So as we can see here, the market was at 3,400 at the highs. Now, when we were there, nobody was buying protection to the downside. And what you should always have is a healthy portfolio made up of long positions, because you want to take part in the expansion of the economy, the growth of human industry and the concepts of entrepreneurship. But you always need to have nature or other things, or the poor choices of man will always cause these type of market gyrations. So it's always very important to keep something that goes up if the market goes down. So my clients, I always teach them and tell them you need to have, even if it costs you 2 to 3% per year for protection to the downside. Years like this, or years like the end of 2018, it is very much going to make up for itself and pay for itself in spades, many times over. So 3,400 down to where we are now. The market ripped through and bled through all the support that we had. And in fact, by breaking the low of Christmas of 2018, it shows that nothing is safe. It has turned into a giant megaphone, and it's trying to figure out where to go. This doesn't mean that we break new lows and go down to 1,600 and go even lower. And it also doesn't mean that we go straight up and make new highs. What it means is there's going to be significant volatility. So with that being said, when the market was crashing, the volatility index went up significantly to the point where we've never seen. Latecomers in terms of portfolio hedgers and regular people to protect their portfolios, and even speculators to buy puts, they bought significantly, and to the point where we've never seen a move like this for people that have been alive. So you always see these giant moves when you have a new generation that has never seen price like this. Price is just a reflection of how we feel. Now, if we remembered how we felt 100 years ago or 111 years ago, we probably wouldn't feel this way, right? If we remembered what the markets were like during market crashes in the past, we probably wouldn't have this type of volatility back and forth. But because the human mind never changes, these patterns always repeat. It's almost biological, in fact. So getting back to where we are now, let the market figure out where it wants to go. Do not be a hero. Could we make new lows? Absolutely. I'll say this, it's gotten a lot cheaper to protect the downside. So if you're worried about the downside to come, consider buying put spreads, or consider having short-dated puts in your portfolio to protect you. Now, the opposite is true. If you think the market's going to go up, it is not expensive to take bets to the upside. And I'm not giving you financial advice, but I'm saying increase your knowledge. Reach out to people, me included, that can give you this knowledge to help you make sound decisions, because that is what will help you sleep at night. And sleep is very important right now if you get sick, if you know what I mean. So if you have any questions, leave them down below. There is so much to talk about here. I'm going to talk about commodities like oil, which is the blood of the world, and there's certain organs that are fighting over each other right now to provide that blood. So there's so much to go over. Interest rates, people are trying to figure out where real estate is headed. We'll go over that in detail. Talk to you soon, guys. Take care.